If you're watching silver right now and thinking, this is just volatility, I need you to stop. Because what's happening isn't random. It's not a mystery. It's not even complicated. It's a machine doing what machines do when you push them past their limits. Here's the claim that's going to sound outrageous until you see the pattern. The next 14 days in silver are likely to deliver a move that won't feel like normal price action. It will feel like the market is breaking, because for a brief window it actually is. And I'm not saying that to be dramatic. I'm saying it because the setup is visible in plain numbers. Global debt is near $346 trillion. That isn't a headline. That's a leverage ecosystem, a world built on borrowed time. Reuters, citing the Institute of International Finance, put global debt at about 345. 7 trillion by the end of September 2025. That's roughly 310% of global GDP. Now zoom in. The US Treasury debt to the penny shows total US debt at 38. $568 trillion on January 29th, 2026. So the world is saturated with debt, and debt behaves like dry grass. It sits there looking calm until one spark hits the wrong place. That spark just hit the silver market. On February 2nd, 2026, Reuters reported that after a historic plunge in silver, CME Group raised margin requirements on silver futures from 11% to 15%, with forced liquidations and margin calls accelerating the move. That is not a small detail. That is the sound of the machine tightening its grip. And if you stay with me to the end, I'm going to show you the exact 4-stage pattern that repeats every time a system like this reaches the edge. Plus, what to watch over the next 14 days so you don't get psychologically ambushed by the swing when it happens. Because the biggest mistake people make in metals isn't being bullish or bearish. It's thinking they're watching a normal market. They're not. They're watching a leveraged system collide with a real physical asset. And when that collision starts, the outcome becomes mathematically inevitable. Let's define the mechanism cleanly without hype. 4 stages. The same 4 stages you'll find in empires, currencies, and modern derivatives markets. Stage 1 is the setup, the foundation. A society builds a money system, a debt system, a trust system. At first, the promises are reasonable. The future claims roughly match the real economy's ability to produce. Stage 2 is expansion. Overextension. The promises grow faster than production. Debt grows faster than income. Financial claims multiply faster than the underlying collateral. The stage feels like progress because it creates temporary prosperity, but it's borrowed prosperity. It's pulling tomorrow into today. Stage 3 is crisis, loss of control. This is where the smooth story breaks. It's not always a recession at first. Often it's a collateral event. Margins rise, liquidity vanishes, volatility spikes, and suddenly participants are forced to sell or cover regardless of what they believe. Stage 4 is the outcome. Repricing, reset. The system chooses survival. Either debts get inflated away, the measuring stick gets debased, or asset prices revalue upward in the shrinking currency unit, or some mixture of all three. This isn't ideology, it's constraint. Reality always forces a resolution. Now here's what most people miss. Stage 3 can look like silver is dead. Right before stage 4 makes silver look unstoppable. That whiplash is the point. Now let's prove the mechanism with history 3 times so you stop thinking this is a one-off. First proof, Rome, the debasement spiral. Rome's early coinage worked because trust was real. Money carried reliable metal content, and the empire's expansion fed the state with taxes and tribute. That's stage 1, promises aligned with resources. Then cost rose, military, bureaucracy, politics. Rome's obligations expanded faster than its productive base. Instead of collecting enough tax to cover it, the state reduced the precious metal content of coinage. Same face, less substance. Stage 2, overextension masked by debasement. Then stage 3 arrived, loss of confidence. People noticed that coins bought less. Prices didn't creep. They recalibrated. Soldiers demanded more pay. Merchants demanded more coins. Hoarding rose. The state tried to enforce trust with decrees and punishments, but you can't legislate confidence into a shrinking unit. Stage 4 was inevitable. The real value migrated back to harder forms. Better coin, bullion, goods. The system didn't get a neat ending. It got stress, disorder, and repricing. That's not ancient trivia. That's the same logic as today. When promises exceed real output, the unit gets stretched until it breaks, and people flee to what can't be printed. Second proof, Weimar Republic and the math of political obligations. After World War I, Germany's political and financial obligations exceeded what its economy could realistically pay. Stage 1 existed on paper, but trust was already weakened. Stage 2 was the attempt to paper over the gap, finance deficits, expand money, meet obligations nominally, while the real burden is shifted onto currency holders. That's the oldest trick in the book because it feels painless at first. Then stage 3, Once confidence snaps, the currency becomes a hot coal. People spend it immediately because holding it is guaranteed loss. Velocity explodes. Prices surge because the unit is collapsing, not because goods suddenly became worth more. Well, savings are erased. Society gets ripped. Stage 4, reset. The system either adopts a new unit or effectively pegs value to harder references. Foreign currency, goods, metal. It doesn't happen because leaders choose it. It happens because math leaves no alternative. Third proof, the United States in the 1970s, the Nixon shock, and the silver eruption. The post-war era had a foundation, Bretton Woods. The dollar was treated as stable and global trade expanded on that anchor. Stage 1. Stage 2, the promises outgrew the anchor. War spending, deficits, and global dollar claims piled up beyond what could be settled in gold at the old terms. In 1971, Richard Nixon ended gold convertibility. That wasn't a preference. It was a system constraint decision. The claims exceeded the settlement base. Something had to give. Stage 3, the 1970s became the public experience of that give. Inflation surged. Energy shocks hit. Trust weakened. Rates eventually had to rise dramatically. In that environment, silver behaved like a pressure gauge. It didn't move politely. It exploded. Then the system reacted with rule changes and margin hikes that crushed leveraged players. And here's the key. In the final act of Stage 3, the system often tightens the screws. Higher margins, higher rates, tighter conditions, right when participants are most exposed. Not because it's a conspiracy novel, because the system is trying to regain control. Now come back to today. Because what you just saw in early 2026 is Stage 3 behavior in a modern suit. Reuters reported a historic record daily decline in silver, followed by the CME raising silver margins from 11% to 15%, with analysts pointing to forced liquidations and cascading margin calls. That is a leverage purge, in plain English. This is the part where I want you to breathe, because most viewers do something dangerous here. They confuse a liquidation event with a verdict on the long-term thesis. A liquidation event is not a debate. It's a forced mechanical sale, and forced sales can slam prices far below fair value until they run out of forced sellers. That's why the next 14 days matter, because in leverage markets, time compresses. The market doesn't give you a gentle transition. It gives you a window where the weak hands are harvested, then a window where the rebound is violent, then a window where the next regime is decided. So let's apply the exact 4-stage mechanism to the current silver setup, step by step, like a checklist. Stage 1, the setup, a debt-based global system. Near-record global debt, near-record sovereign debt, an economy where stability is often maintained through refinancing and liquidity management instead of actual deleveraging. Check. Stage 2, expansion, financial claims multiplying faster than reality. In a high-debt system, the political cost of pain becomes unacceptable. That means the system leans toward policies that keep refinancing possible, keep markets liquid, and keep default cascades contained until inflation or credibility forces tightening. That push and pull is the expansion stage. More claims, more leverage, more dependence. Verified. Stage 3, crisis. Collateral stress and forced flows. This is where silver becomes dangerous because it's a smaller market than many people realize, it's heavily traded, and it attracts leverage because the moves are tempting. When volatility spikes, the exchange raises margins. When margins rise, leveraged traders must post more collateral or exit positions. When they exit, selling accelerates. That's how you get waterfall moves. Undeniable. Now, stage 4 is where the story becomes prophetic. Not mystical, prophetic, in the sense that you can see the options narrowing. Stage 4, outcome, repricing and regime selection. Here are the two paths, and neither one is comfortable. Path 1, the system stays tight. Rates stay restrictive. Liquidity remains constrained. Leverage continues to unwind. In that path, silver can stay volatile and pressured with violent rallies that fail until the unwind finishes. Path 2, the system blinks. Some form of liquidity relief appears, overt or quiet, because broader market stress becomes too politically expensive. In that path, real assets reprice higher over time, not because they're better, but because the unit is being protected from collapse by being diluted. Both paths produce volatility. Both paths punish the unprepared. But only one path tends to dominate in highly indebted eras, historically. The path where survival beats purity, which is why metals keep returning over and over across centuries, across regimes. Now, let's talk about the next 14 days without pretending we can predict a candle. Here's what I'm expecting you to feel emotionally, and I'm saying this so you're not surprised when it happens. First, the market will try to convince you the move is over. It will bounce. It will look normal for a moment. Then it will shock you again, either down with another flush or up with a snapback that feels like a glitch. That emotional whiplash is exactly what causes people to do the wrong thing at the wrong time. So instead of chasing feelings, watch the machine indicators. Indicator 1, do margin hikes continue or stop? When exchanges raise margins, it means volatility is still too high for the current leverage. If margins keep rising, more forced selling can occur. If margin changes pause, it often signals the purge is nearing exhaustion and the market can start rebuilding. Indicator 2 is liquidity returning or disappearing. You'll see this in how fast price moves through levels, how violently it snaps back, and whether rallies get sold immediately or allowed to breathe. In liquidation regimes, rallies are often sold because participants are still de-risking. In reversal regimes, rallies hold because forced sellers are gone. Indicator 3, does the narrative collapse? The last phase of a purge is psychological surrender. This is when people say, silver is finished. It was all a scam. I'm never touching this again. That's usually not the start of a new bull market, but it's often near the end of a forced selling event. Indicator 4, does the dollar surge or stall? Reuters tied the latest commodity slump to a stronger dollar and shifting expectations around Fed leadership and policy. If the dollar keeps strengthening hard, metals can remain under pressure. If the dollar stalls while inflation expectations or risk rise, metals often catch a bid quickly. Now let's do the part that dramatically increases your accuracy, even if you never trade. Separate paper silver from silver the metal. Paper silver trades like leverage, like positioning, like a crowd. Physical silver trades like scarcity, fabrication capacity, and real-world demand. When the paper market is purging, it can smash spot price even while physical premiums remain sticky. That tension is not a conspiracy theory. It's simply two layers of the market moving at different speeds. And this is where I want to insert the one open loop that matters most. The number one signal that stage 3 is ending is not a headline. It's exhaustion. Exhaustion looks like this. The market stops going down on bad news. If you see that behavior inside this 14-day window, pay attention, because it often means the forced sellers are mostly done, and the market is ready to reprice to whatever the next regime is. Now, I need to address something directly, because it's the retention killer flaw that sinks most finance videos. Most creators try to prove their thesis by stacking facts, debt numbers, inflation charts, political commentary, until the viewer feels lectured instead of guided. So here's the clean truth. You do not need 50 facts. You need one mechanism that explains 50 facts. And the mechanism is the 4-stage cycle: setup, expansion, crisis, outcome. If you understand that cycle, you can watch any chart without panic. You'll realize that crashes and spikes are not contradictions. They're different phases of the same machine. Now let me give you the practical takeaway without giving you personal financial advice. If you are a long-term allocator, someone who believes silver is insurance against currency debasement, then your primary job is not to predict tomorrow. Your job is to avoid getting shaken out during stage 3. That means position sizing. You can hold through violent drawdowns. No overleverage. No all-in mentality. Because the system loves all-in players. It harvests them. If you are a short-term trader, your job is even harsher. You must respect that the exchange can change the rules of the game through margin requirements, and that volatility can expand beyond what your model expects. You are not fighting a chart. You are fighting collateral requirements. One more thing, because this is where people get fooled by the screen. Silver is not just a macro hedge. It is also an industrial input. Demand doesn't only come from fear. It comes from factories, energy infrastructure, electronics, and supply chains. And when a metal lives in two worlds, money and industry, it can behave like two different assets depending on which side is dominating that week. The Silver Institute has been pointing to a multi-year structural deficit in the silver market, meaning demand has been running ahead of supply for several consecutive years. That doesn't guarantee a straight lineup, but it does mean the paper market can throw the price around while the underlying metal stays quietly tight. And that split is where the next shock can hide. Because the moment paper selling exhausts, even a modest wave of real buying can flip the market from falling knife to vertical move. Not because everyone suddenly becomes bullish, but because the available float is thinner than it looks after leverage gets flushed out. Now, picture this in human terms. A leveraged trader wakes up after a sharp drop. Their broker says, "Your margin requirement changed. Post collateral by end of day or we liquidate." They don't get to debate fundamentals. They sell. Multiply that across thousands of accounts. That's the waterfall. Then, days later, that same trader sees silver ripping higher, not because the world got better, because the forced sellers are gone. And the shorts are now the ones who have to meet collateral. That's why this 14-day window matters. It's not superstition, it's mechanics. So use a simple countdown. Early in the window, expect chaos. Mid-window, watch for false calm. Late window, watch for exhaustion. Price refusing to fall on bad news and snapping back violently. If you see that behavior, pay attention. Now, here's the final warning. And I'm going to say it in a way you won't forget. Silver doesn't punish ignorance, it punishes certainty. Certainty makes you oversize. Certainty makes you refuse to cut risk. Certainty makes you buy because you know it's the bottom, or sell because you know it's over. But this market isn't about what you know. It's about what the machine forces. And the machine is forcing a reveal right now. Global debt saturation. Check. Sovereign debt pressure. Verified. Margin tightening and forced liquidation in silver. Undeniable. So no, this is not just another week. This is a system moment, and in system moments, the next 14 days can contain a lifetime's worth of volatility. Now I'm going to close the loop I promised at the beginning. What should you watch so you don't get ambushed? Watch the margins. If margin pressure escalates, expect more forced flows. Watch the pace. If price stops falling on bad news, exhaustion may be near. Watch the dollar. If it stalls, metals can rebound violently. Watch your own psychology. If you feel desperate to win it back, that's usually the moment the machine is about to punish you. And remember, the outcome phase of this pattern is not announced. It arrives. When it arrives, it will feel like overnight. But it won't be overnight. It will be the consequence of a system that took decades to overextend. So here's what I want you to do right now. If this video changed how you see silver, if it made you realize you're not watching a chart, you're watching a machine, subscribe. Because in the next video, I'm going to break down how that machine was built. How debt, liquidity, and derivatives create these violent resets, why the public always notices too late, and what the next stage looks like after the purge ends. And if you want to survive what's coming, don't chase the candle. Understand the cycle, because the cycle doesn't care what you believe. It only cares what the math demands. Reference notes, not for voiceover. Global debt estimate, US. Debt daily total, CME silver margin hike, plus forced liquidation reporting, broader commodity slump plus strong dollar framing, multi-year structural deficit discussion, retention tactics. Background on pattern, interrupt Sartorius retention,